Good morning, ladies and gentlemen. My name's Sue Staunton and I'm Joint Managing Partner of James Cooper Creston. I'm delighted to welcome you to James Cooper Creston's Autumn 2021 Budget Seminar, during which we're going to be considering the key announcements and implications of what Rishi Sunak yesterday termed a budget for a stronger economy for the British people. It was a budget well leaked in advance, of course, with suggestions from the Speaker that those who leaked should walk or resign, following the earlier example of Hugh Dalton. And of course, the Deputy Speaker yesterday issued her own reprimand. With me this morning to guide you through the ups and downs of the budget are some of my fellow partners. Alex Nicholson, one of our business tax partners, who will be summarising the key matters as we start. Following Alex's presentation, we then have a panel of experts from across the firm who will debate issues raised by the budget. On the panel, I'm delighted to welcome Ian Miles, our Head of Tax and Private Client Tax Specialist, Sharon Bedford, Head of our Business Tax Team, Meera Raja, who is Head of our Indirect Tax Team, and Darren O'Connor, who is Head of our Accounts and Advisory Team. So I'd like to hand over to Alex to kick us off, please. Alex.
Thank you, Sue, and good morning, everyone. Yes, so as Sue said, it falls to me really to run through the headlines. And I always like actually on budget, well, the day after the budget, to have a look at the headlines that are in the papers and to see what, what's going to give me a little bit of a laugh. Actually, I have to say, when I looked this morning, it was very, very flat. I mean, the Metro led with Cheers Rishi, Daily Mail, The Drinks Are On Us, The Telegraph, Hey Big Spenders. And the Eye had Big Spender Sunak takes tax burden back to the 1950s. So I think, there's nothing humorous in any of that, but all about the spending really. And we'll come back to that a little bit later on. So diving into the detail, if I could have the first slide, please. So we'll kick off with matters affecting individuals. So I think back in March, we were questioning really whether the manifesto pledge not to raise income tax, national insurance and VAT rates was intact. I think everyone's quite clear now that has been abandoned. And of course, the major tax rise really, which was announced a few weeks ago, is the increase to national insurance that's going to go up by 1.25% from April 2022. And that's going to apply to Class 1 national insurance, which is paid by those who are employed, and also the self-employed who pay Class 4 national insurance. That's actually a sort of precursor really to a new tax which is going to come in from April 2023 called the Health and Social Care Levy. So basically NICs are going to go up for 1 year, but then the Health and Social Care Levy is at least initially going to be at the same rate of 1.25%. And the difference really between the two is, well, the reason the levy is not coming in April 2022 is just because actually it's going to take the government some time to update its systems and get ready for this new levy. But the difference really between the two is that the Health and Social Care Levy will also be paid by working pensioners. So that's a 1.25% tax rise then from April 2022 on NICs, to be followed by the Health and Social Care Levy. And of course, the Health and Social Care Levy, we're told, is specifically going to, pay for the NHS and also for social care in old age. The other tax rise then that was announced recently, wasn't specifically mentioned in the budget yesterday, is that tax will also go up on dividends. So really, what that's aimed at doing, it's 1.25%. But the aim is that if you're remunerating yourselves via dividends, as many owners of companies will do, then they won't escape this 1.25% increase. So again, that's from April 2022, which gives us the new dividend tax rates. So if you're a basic rate taxpayer, broadly, if you've got income of up to about £50,000 per annum, then your rate will increase from 7.5% to 8.25%. If you're a higher rate taxpayer, then the effective rate of tax on dividends is going up to 33.75. And if you're an additional rate taxpayer, that's those with incomes above £150,000 per annum, you're getting now close to 40% tax on your dividend at 39.35%. So those are the major sort of tax increases really that we're seeing on the personal tax front. At the moment, individuals who sell UK residential property have to file a return and pay any capital gains tax that's due to HMRC within 30 days. That's caused a lot of problems for people because it's quite a hard deadline to hit. So it was announced yesterday that that's going to be extended to 60 days, a welcome extension there. Just a reminder, really, nothing was said on this yesterday, but it was announced back in March that various thresholds would be frozen until April 2026. So just a reminder, really, that the rates at which you start paying the higher rates of income tax and the various NIC allowances, CGT annual exemptions and inheritance tax thresholds have all been frozen until April 2026, which is in effect a tax increase, and we'll just see the impact on that a little bit later on. A non-tax measure, but just welcome for many, especially those on lower paid jobs. The national living wage is going to go up by 6.6% to £9.50 per hour from April 2022. There were also significant increases for the national minimum wage for younger age groups. I think the living wage applies if you're 22 years old or older. But yes, similar sort of increases, some actually bigger in percentage terms for younger workers. Much has been made in the press, of course, of the universal credit taper, allowing those who are doing some work to retain more of the benefit of their universal credit for longer, really. And of course, the work allowance increasing by £500. I could have the next slide, please. So moving on then to businesses, the 1.25% increase in national insurance also applies to employers' national insurance, which is going to go up by 1.25% from its current rate of 13.8%. So the so-called jobs tax. So in actual fact, the NIC increase really for those who are employed, albeit that it's spread between the employee and the employer, is actually really an effective tax rise of 2.5%. Which is quite significant and obviously allowing the Chancellor to raise some serious cash. Again, that becomes the health and social care levy from April 23. It was also announced yesterday that the annual investment allowance, which is an allowance that allows businesses to write off 100% of the cost of most plant and machinery in year one, will be extended. It's currently £1 million up to the end of this year. That £1 million limit is going to be in place for another 15 months beyond that, so it's extended to March 2023. There were a couple of fairly significant changes announced in relation to R&D tax credits, which we're going to pick up on a little bit later on this morning. Sharon's going to detail those. We also saw residential property developer tax being confirmed. This is effectively to help pay for the cladding issue, the government part of that support for dealing with it. And basically, it's going to be an additional 4% tax on profits of the larger sort of property developers, and that's those that have profits of over 25 million per annum. And it's actually forecast to raise about £200 million per year. So it's significant for those businesses that are impacted, but fairly limited in scope. Just a reminder that the headline rate of corporation tax is going to increase to 25% from April 2023. That, of course, was announced back in March. So again, no new announcements there, but quite a significant impact for businesses, and we'll see the forecast of that in just a moment. And finally, on this slide, just a mention for basis period changes. It did get a little bit of press when it was announced a few weeks ago. It was initially going to come in the next tax year. It's now been pushed back to 23-24. It won't have an impact for a lot of people, but basically if you are self-employed or you're in a partnership and you have a year end which isn't aligned with the tax year end, i.e. a March year end, then this could mean that you end up having to pay some tax sooner effectively, and it will be something that you will need to plan for. But I think most small businesses and the self-employed would tend to use a March year end, and if you do have a March year end, it won't have any impact for you. Next slide then, please. So just a mention really about business rates. There was quite a bit made of this in the budget yesterday, and welcome news really for a large number of businesses. So the multiplier that's has been frozen until March 2023. So it's been sort of extended by, I think, another year. So basically no change to the current rates that are applying, and the planned increases there have been cancelled. Further relief really for retail, hospitality and leisure properties, where the 50% relief from business rates, which is currently in force, is being extended throughout 2022 and 23. It won't help very large or larger businesses in those sectors though, because it's a £110,000 cap per business. But again, that will be very welcome to many smaller retailers and those operating in the leisure and hospitality sectors. The Chancellor also made a fair amount of mention of improvement relief, but basically that just means that if you're making improvements to your properties, it won't come into your rateable value for the first period effectively following those improvements, and the adjustment to rateable value will be made a bit further down the line after 12 months. There were some very targeted business rates exemptions aimed at supporting the green agenda. They're no doubt useful for some, but I won't go into the detail on that here. And it was also mentioned that the revaluations for the purposes of calculating business rates is going to be done every 3 years. Currently, that's every 5 years. Also on this slide, then, just a repeat really of that mention of the national living wage increasing by 6.6%, because of course, for many businesses, that has a very significant impact on their cost base. Finally, on this slide, then, the recovery loan scheme was the scheme that kind of replaced some of the more dedicated COVID announcements that we had last year, for example, the CBILS loan scheme. But anyway, that's been extended to June 2022, and basically the government's guarantee that they're giving on these loans is being reduced from 80% to 70%. And previously it was available on loans of up to 10 million, but it's going to be available on loans of up to 2 million. So anyway, there's still some government-backed guarantee to help businesses that are still struggling really to borrow some additional funds. Moving on then to duties. Well, going back to those headlines, of course, cheers, Rishi. Yes, alcohol increase in alcohol duty has been cancelled, and it's proposed that there'll be a complete reform of alcohol duties linked to the percentage volume of alcohol from April, I think, 2023. It's going to be subject to a consultation at first, but according to the Daily Mirror, that does mean that if you're a Prosecco drinker, you should on average save 62 pence per bottle. But also according to the Daily Mirror, and I don't profess to know this drink, but if you like Frosty Jack's cider, apparently that's going to increase by 45p for 750 millilitres. And if you like Hardy's Merlot, that's going to increase by 35 pence a bottle. So essentially, anything which is a bit sort of stronger is going to attract more duty. Anything which is a bit lighter is going to attract a bit less. And you'll either be a winner or loser in that, depending on what you like to drink. Some changes announced to air passenger duty. Basically, it's going to be halved on domestic flights. Lots in the press today about that being a terrible thing for the environment and such like. An increasing air passenger duty for ultra long haul flights, which I think was flights above 5,000 miles, which is going up to £91. As ever, tobacco has increased significantly and is not just RPI linked, it's RPI plus 2% on cigarettes and plus 6% on rolling tobacco. And of course, RPI is running at 4-point-something%, so some very hefty increases there. Vehicle exercise duty just up by RPI, and fuel duty has been frozen yet again for the 12th year in a row. Moving on to the next slide. I think it's notable really that the lack of changes that were announced yesterday, that was the bit that really struck us. It was all about the spending. The tax increases had been pre-announced. So on VAT, we saw no major changes announced yesterday. I mean, I suppose notable for its absence was the fact that there's no VAT cut on heating costs, which had been called for to help people who are struggling with the increased cost of fuel or will struggle over coming months during the winter. No CGT changes. Of course, it had been much muted in the press that there might be significant changes to capital gains tax, increasing the rates. As a reminder, the main rate of capital gains tax is currently 20%. So that hasn't changed. There is a 28% rate for certain property disposals, but for other assets, it's 20%. So the rules as we know them for business asset disposal relief, previously entrepreneurs relief, which provide a 10% rate of tax on gains of up to £1 million, remain. It's still possible for business owners to look to sell their businesses or a controlling stake in their businesses, at least, to employee ownership trusts and pay no capital gains tax on that. That has seen an increase in take-up, whereby effectively that part of the business that is sold is held in trust for the benefit of all the employees. I think it's also worth mentioning that investors relief is still available. This was originally an extension to entrepreneurs relief, but to attract external rather than internal investment. And it generally isn't available to employees, but it does provide a 10% tax rate on up to 10 million of gains still, actually, where individuals make qualifying investments into companies which typically they're not involved with on a day-to-day basis. Having said that, there are some limited exemptions, and it is possible for an individual to make an investment into a company and to become an unpaid director. So a valuable relief for some, and one that hasn't actually been restricted in the same way as business asset disposal relief. Also then, no changes to inheritance tax. As I've mentioned before, the threshold at which that starts being paid has been retained. But business property relief from inheritance tax at either 100% or 50%, depending on the nature of the asset, has been retained, and agricultural property relief has also been retained. Finally then, no changes to pensions either. It had been suggested that there might be a restriction of tax relief for higher rate taxpayers. That hasn't happened. So moving on then to my final slide, I just thought it was, given all the spending announcements that have been made, I just thought it was worth a little bit of a look at, where that tax is all coming from, or forecast to come from, to pay for it all. You've probably seen in the press overnight and this morning that the government, the Chancellor, has effectively set a budget that is going to increase the tax take to 36.2% of GDP by 2026. That's the highest level since the 1950s under a Labour government. So just looking at the increases here, I mean, I think the table that you can see in front of you sort of sets out the key taxes, being income tax, national insurance, corporation tax, and VAT. And at the bottom, that's not a summation of the amounts above. That's actually all taxes, so factoring in all the other taxes that are not on the table. But you can see how, from where we are today, where the Chancellor expects to take 776 billion in taxes this year, over the next sort of 4 to 5 years, that's forecast to go up by approximately sort of 28%. And of course, the big contributors to that then are these national insurance plus the health and social care levy, which you can see adding 25 billion between 22 and 23 there. And also then the corporation tax hike. So corporation tax also, forecast to be a much bigger tax than it is at present. I think it's also just worth noting that spending as a proportion of GDP is set to go to 42%, which is its highest since the 1970s. So, lots and lots of spending. But I think one of the things that's making this possible is actually the bounce back has been stronger. And just looking at the comparison of these numbers before you, since the forecasts back in March 21 actually have added sort of 44 billion this year because of the stronger bounce back that the Chancellor has now had to play with. He's obviously chosen to use that money to invest in spending with the promise of tax cuts further down the line. We wait to see whether that happens. So I think that's all from me, and I'll now hand back to Sue. Thank you.
Thank you very much, Alex. Interesting food for thought. Picking up on some of the commentary, of course, that's been in the press this morning as well, as people have been digesting what came out yesterday. We now move on to our panel session. If you have any questions to pose to the panel about the budget, please do post those in the questions section on your screen, and we will do our best to pick these up as we go along, and certainly we'll have a summary at the end. So firstly, Darren, obviously it was pre-announced that there's going to be an increase in dividend rates and national insurance rates. We now know that the CGT rates haven't changed. What impact do you think this is going to have on SME businesses and their owners?
Okay, thanks, Sue. This is something I regularly discuss with my clients. As you say, dividend tax rates increasing, national insurance contribution rates increasing. This, it's fair to say, will make profit extraction more costly for business owners, whether they pay themselves via dividends or payroll or a mixture of both. So this now may be the time that a business owner may consider a capital disposal. Capital disposal can take on many forms. It could be a full trade sale where you sell to a third party. It could be a part disposal. It could be a management buyout where the management team buy a stake within the company. Or it could be an employee ownership trust, which Alex alluded to earlier, where collectively the employees take a stake in a trust which has a stake within the company. All of these could and should result in a capital disposal and would allow for the business owner to hopefully benefit from a 20% tax rate or perhaps even a 10% tax rate if business asset disposal relief applies. So I think it's food for thought for business owners, whether now is the time to think about an exit along their life cycle and journey of the business.
Thanks, Darren. And Ian, do you think this is a short-term solution and situation rather? And do you think that business owners therefore do need to start thinking about acting more quickly?
My own personal view, Sue, is that it isn't. I think it's a longer term issue. So just to reiterate, all the planning that you could do either in terms of selling or handing the business on to the next generation that you can do at the moment, you're still going to be able to do after today and into the next tax year. There was a huge amount of speculation in the press that CGT rates would be aligned with income tax rates, and I'll come on to the reasoning for that in a minute. And if we look back over history, we actually had aligned income and capital gains tax rates from 1988 to 2008, and then the 18% rate came in, and then in April 16 the 20% rate came in as the headline rate. But I don't think it's a short-term measure. If we just look at the amount of tax that's raised, and my figures are very slightly different to Alex's, because what I think I've got, and it's all from one source, is the amount of tax raised in the year ended April 21. CGT raises 10.6 billion, IHT raises 5.3. You compare that with income tax at 195 billion. The taxes are emotive, but they don't raise a huge amount of revenue for the Treasury. So I think there's no immediate desire for the Chancellor to do anything. If we look at some of the consultations that have come out, the Office for Tax Simplification issued their findings from a consultation in July 2019 on inheritance tax. And they issued 2 on capital gains tax, 1 in November 2020, and an update which on practical issues to do with CGT in May 21. And they were talking about aligning the rates with income tax, but they were also hinting at a complete reform of the 2 taxes so that the 2 sit much more comfortably alongside each other, and that the borders between capital gains tax and income tax are aligned, and the borders between CGT and IHT are aligned. One thing they did say in their report was they recommended that the Cgt reporting deadline be extended from 30 days to 60 days. And so that has come in. So the Chancellor has clearly listened to that. One of the other things they talked about, which hasn't been announced yet, but alludes to something Darren was saying, is that when you look at complicated business disposal deals where the consideration may be deferred over a number of years, and you might get business asset disposal relief, for example, at the start, but then not on the subsequent tranches of money you get. They're recommending that that's brought in as well, so that you get the reliefs all the way through. If you qualify them for the start, you get them through the way through. So my own personal thoughts are, if you're thinking about selling, it's probably no bad thing to get on with it when the time is right, but I don't think it's a driver you've got to do it now.
Thanks very much, Ian. That's very helpful. Sharon, the Chancellor's claim that this is a budget for business. Do you agree? You're muted, Sharon.
Sorry, apologies. Rookie error there. So yeah, no, Sue. I think that's a very good question. I suppose it'd be quite interesting. There's probably a lot of business people and our clients on this call, and I suspect if I were to ask them all, they might not necessarily think so, because they would know that there are some challenges up ahead. And it's not a clear picture. I mean, clearly there was some good news yesterday, depending on which sector you're in, and we'll come on to discuss those in a little while, specifically for the hospitality and leisure centre, and also for technology businesses. But generally, my view is that the news isn't, particularly good from the budget yesterday. I was sort of a little surprised yesterday towards the end of his budget speech that the Chancellor actually sent to make an apology. He almost apologised to the country, or arguably maybe it was aimed at his backbenchers, that he had to raise taxes so much this year. And when you stand back from that, building on the table that Alex had on his slides, an awful lot of that tax increase will fall on business. As Alex said, 1.25% increase on national insurance, and then being rebadged as the health and social care levy, is a 1.25% increase to most businesses' wage bills. And certainly when we're talking to our clients, one of the things that they're finding in a lot of sectors at the moment as well is that there's a shortage in the supply of labour. And of course, where that's the case, it's often the case that those employees or trade bodies are able to, help negotiate wage increases to maybe, compensate them for the 1.25% that they individually are going to pay. So it's not inconceivable, really, that there could be, up to 2.5–5% levy on businesses, and certainly I think that's worrying. And obviously that's from April next year. And then you have to add to that the following April, there's going to be a really significant hike in corporation tax, from 19% to 25%. Rishi's still claiming that that's competitive with other developed economies, but if you're not used to paying it and suddenly you've got to find that extra tax, then that could be quite significant to your business.
Yeah. And is there anything that you think businesses can do now to plan ahead of this increase in CT rates?
Yeah, no, it's interesting. We're starting to have all these sorts of conversations with our clients at the moment. So I think to answer that, we also have to reflect a little bit on what happens when businesses are actually spending money on capital items, on capital expenditure. As Alex said yesterday, there was a welcome extension to the annual investment allowance, which allows businesses to write off their capital expenditure in the year that they incur it. And that's been extended to March 2023. And also there is a temporary initiative in place where actually you can get 130% write-off, the so-called super deduction for certain amounts of capital expenditure, and that is supposed to be also ending in March 2023. So in some respects we've got a bit of an Armageddon sort of being stored up, in that we've got these initiatives allowing more tax relief for capital expenditure ending in March 23, at exactly the same time that rates are going up. So there is a big worry. Some other things you could do, I guess, if you are a business struggling for cash, you know, essentially you want to pay as little tax as you can now. But if you're not in that camp, if you know, have got access to cash and funds, there is some planning that you can do to potentially, you know, have lower taxable profits now, to then have higher taxable profits in, you know, after the rates have gone up, and therefore, you know, over a course of a number of years pay, you know, less tax than you would do otherwise. And there are some legitimate ways to do that. Some of the things we just talked about, the annual investment allowance, capital allowances more generally, you don't have to claim in any year. So you could potentially carry the relief of those forwards and set them off profits when you know, when tax rates are higher. Also, if you're a business that perhaps suffered a loss because of COVID in the last couple of years, you may recall that the Chancellor brought in some emergency sort of help, really, and that businesses were allowed to carry those losses back for up to 3 years and get a tax repayment. And I think that was very welcome at the time, because a lot of businesses were panicking about where their cash was actually coming from. Arguably now, if they find themselves in a slightly better position, they might want to carry those losses forward instead and get relief for them at 25% in 2 or 3 years' time. So lots to think about. Each business is unique and different, and certainly, you know, I think we should be having those discussions now and just mapping out what's best for each individual circumstance.
I mean, that speaks to, you know, quite a lot of consideration that companies and their owners should be placing on these sorts of issues at the moment, to actually start to, you know, map out their short, medium and longer term strategies, not just from a tax point of view, but actually, as Ian was talking about, in terms of, you know, whether to contemplate sale or not sale, or you know, part disposals and so on. What we'd like to do now is to get a temperature and a sort of view from you, our audience, as to what you think the biggest threat to your business in the short term is, whether this is inflation, staff shortages, supply issues, which there's been a lot about recently, of course, and the energy costs, notwithstanding the you know, freeze on the fuel duty hike. So you'll see popping up on the right hand side of your screen the opportunity to take part in that poll. So if you could do that now, that would be fantastic. And we'll come back to that and consideration of answers to our other poll questions at the end of the presentation. So, Darren, you know, most of the factors that we're looking at in terms of the poll here, inflation, staff shortages, supply issues and energy costs, indicate supply side inflationary pressures. What advice would you have and are you giving to our clients around these sorts of issues?
Okay, thanks, Sue. Yeah, I think, and it was clearly signposted in the budget, that we're going into a period of higher inflation, perhaps over around 4% or perhaps slightly higher, clearly a lot higher than we've seen for a very long time. So when advising businesses, my first and crucial piece of advice would be to keep an even closer eye on your gross profit margin, something you would always do anyway, but in times of inflation, clearly crucial. But then also your net profit, it's not just your cost of sales that are going to be increasing. There could be some significant overheads also increasing. Ensuring that you have KPIs that are suitable and specific to your business, and monitoring them and being able to take swift action if required. Pricing models that are clear and coherent, particularly when you're pricing for work and for projects that may be fulfilled later down the line, perhaps several months later. Some businesses will look to forward contracts and other instruments to secure the price of vital raw materials, products, etc., at today's price, which would clearly help the pricing model. But I think in short, tough decisions will need to be made by business owners as to whether the inflationary pressures can be passed on to the customer or consumer. And in some industries, in some sectors, that will be possible. In others, it probably will not be. So tough decisions for businesses in the short, medium term, I would suggest.
And do you think that means that in some cases, companies are better to walk away from certain customers than to try and fulfil contracts that will be unprofitable for them?
Yes, yeah, certainly. Being a busy fool is never a good business mantra. So I think being in a position where you do know where your profit is driven from, and ensuring then that you can act upon it, and if there is very slim profit margins in there, and that's before any contingencies, I would suggest it probably isn't where you want to put your effort. So certainly something business owners should be looking at.
Yeah, thank you very much. Now, in the budget yesterday, it's very clear that there are sort of particular parts of the government's industrial strategy that were coming through, because there were certain key industries being referred to and sectors that the government are appearing to look at as sectors of growth for the UK economy. Now, one of these big sectors that we're really pretty good at is that of entertainment. And Mira, you work a lot for businesses in this sector. In this budget, have there been any real benefits announced, or is it just sort of a bit illusory?
Yeah, thanks, Sue. The entertainment industry has, as all of us know, has suffered a lot. Yes, there's definitely some good news for companies claiming tax reliefs for theatrical productions and museum and gallery exhibitions. The government intends to raise the rates of 3 corporation tax relief that are collectively referred to as cultural relief. So that is like, 3 reliefs, which is theatre tax relief, orchestra tax relief, and museum and galleries exhibition tax relief. The rate increase is intended to last for 2 years and 5 months, beginning from 27th of October 2021. So that's like, quite immediate. The rates will taper down from 1st of April 2023 before returning to current levels from 1st of April 2024. The rises will apply where production activities commence on or after the 27th of October 2021. The real benefit for theatres, orchestra, and museum and galleries exhibitions are from 27th of October 2021 until March 2023, the tax relief will double. So I'm sure that the theatres, orchestra will be will start to look at scripts and start to look at the projects, because this is a time, once you start doing it, and then it'll be, it's basically when you double your tax relief, it is definitely beneficial for this sector, which is pretty much, suffered a lot in the last couple of years. There's also good news, but also some good news for film production companies, because at the moment there is a switch between film tax relief and high-end TV relief during production. So currently, to qualify for film tax credit, the film has to be the intention of the film to be released in the theatre, and they've switched now. Now the intention has changed, so the film's intention is to can be to broadcast, so which means it can be released on Netflix and Amazon. So the film production companies will qualify even if they are going to release these films on television. So it'll be, I think this is all part of COVID, and people weren't able to go to cinemas, and some of the film production companies did suffer not being able to release this. So this is pretty good for them. So on the whole, I think there is a benefit for the theatrical industry, and the entertainment industry is very good. And especially for the theatre and orchestra, like I said, I reiterate, from 27th of October 2021, from March 2023, when the relief will be double, that's when I think the benefit is more for the theatre, orchestra, and museum, galleries, and exhibitions.
Thanks, Mayor. I mean, just, the UK has been very preeminent in the film industry. And of course, we know that there are a number of new studios, big studio complexes being built in the UK. Do you think that the change to broadcast rather than cinema release for film tax credits makes us more competitive than other locations for filmmakers?
Yes, most definitely, because one of the reasons where a lot of the films are filmed in the UK is the post-production studios, and how we have a lot of infrastructure around the film production, makes it for them it's attractive, and not just the locations. It's also a lot of the studios are now being built where you can do a pretty high-end film production. Now, yes, there will be an appetite for more film production companies to come here and film, because you will qualify for this film tax credit on the basis of, you can release it in Netflix and Amazon Prime. There is a lot of news out there to say that the content is going low at the moment for Netflix and Amazon. So there will be a great appetite for film production companies to come and film and make use of these studios, because there are a lot of high-end studios are coming up. So it'll be, yes, of course, we will, I'm hoping, and we will see a lot of film production companies coming into the UK, and also British film. It is very good for the British film industry.
Excellent. Thank you, Mira. And of course, this idea of incentivizing through tax credits is something that successive governments have been utilising across different industry groups, and the biggest winner potentially has been historically that of technology-based businesses through the R&D tax credit schemes. Sharon, how will the clients who've been utilising R&D tax credits be impacted by the announcements that were made yesterday?
Thanks, Sue. Potentially quite majorly, actually. And as you know, we do an awful lot of work with R&D tax credits with an awful lot of the technology businesses throughout the Thames Valley. And in some respects, I feel a little bit sorry for them, because I don't think there's been many budgets over the last number of years where something or other hasn't changed in the R&D tax credit field. Sometimes it's good news and sometimes it's bad news, and I think we've got a little bit of both of those scenarios announced yesterday. On the good news first, I mean, there has been an ongoing consultation into R&D tax credits for a while, and one of the things that the industry's been calling for is that when you look at the list of expenditure that qualifies for the relief, that it would be necessary to, or that it would be really good for businesses if they were to be able to add data and cloud costs into their claims. And I think that reflects really, where we are today in the technology sector in the UK, and just how important those are to research. The great news yesterday is, yes, they announced that they've listened and that those changes are going to take place. Potentially the not so good news is the way that R&D tax credits are going to be targeted more going forward into UK business. And it was really interesting yesterday, and it was statistics I'd not heard quoted before. And the Chancellor pointed out that 48 billion is paid out in R&D tax credits, which I think that's people knew it was of that sort of order. But they've done some research, and they estimate that only 26 billion of that 48 billion, so really only a tad over half, goes to UK businesses. And they want to do something about that. Interestingly, I think they probably now is the time that they can do something about that, because now we've left the EU, they're no longer necessarily constrained by the rules that the EU put on our R&D tax credit system. And so it'll be interesting to see what happens. I say it'll be interesting to see what happens, because as yet we haven't got the detail, and that's promised in the next 2 or 3 weeks. So, you know, watch this space, and certainly we'll be getting press releases and other things out and talking to clients just as soon as we have more details. Speculating what it could mean. It could mean that you only get R&D tax credits if you are creating UK IP. That's one of the possible things it could mean. I guess of another concern, and one that might affect, you know, quite a lot of our clients actually, is where they do the research in an overseas location, an overseas subsidiary. Maybe they have to do that because, for instance, they need specialised skills or access to labour. For instance, software programmers, often people will use non-UK people. Doing clinical trials, sometimes you have to do the clinical trials not in the UK. And if it means that that expenditure, because it's not in the UK, can't get R&D tax credits, that's going to be a real hit for some of our clients. So yeah, we're watching those announcements. We actually sit on the HMRC RDEC committee. My colleague Margaret Savoury sits on that. And you know, we will certainly get that information out to relevant clients just as soon as we know exactly what's going on, but a little bit of a concern there. I think finally in R&D, just a little sort of general warning really in the press releases and from the Chancellor, that they are continuing to tighten up on R&D tax credits. They're an absolutely valuable lifeline for an awful lot of businesses. But I think it's probably true to say that HMRC believe that some businesses are probably not particularly well advised, and that there have been some claims that either shouldn't have been made or are inflated above what they should be. HMRC, we know, are taking this really seriously. They're taking some of these cases to the tax tribunal with a lot of success. And they intend to carry on doing that and to tighten the rules so that the R&D relief actually goes to the companies, you know, that really genuinely are entitled to it. So yeah, some interesting things there, and watch this space. But Sue, I think R&D tax credits, you know, whilst important, were only part of the government's sort of help and incentivisation of technology businesses. And I know you've been looking at some of the other changes that were announced yesterday.
Yeah, absolutely. I mean, the announcements on science and technology were very interesting. Some of them were new and some had been pre-announced. I don't mean over the last few weeks, but actually been pre-announced in previous budgets and industrial strategy papers. I mean, overall, the big headline for technology was a reaffirmed commitment to expenditure of 20 billion on R&D and innovation by 2024-25. The eagle-eyed amongst you, though, will have noticed that it's actually 2 billion less than announced in 2020 to be invested by that date. So what they appear to have done in the announcements yesterday was to push the final 2 billion out by another to 26-27. But generally, I mean, the temperature check that we've been taking is the science community are broadly still welcoming the commitment, because it's a reiteration of the commitment to significant spending on R&D. There's been a little bit of press over the last few weeks which has indicated some uncertainty as to whether the Chancellor might be going to, cut back expenditure on R&D quite significantly. And there's been a lot of lobbying, I know, going on of central government to say, innovation is still the pump house, the priming house for the growth of the UK economy. So I think, people are welcoming the fact that they're still committing to 20 billion. There are a number of initiatives, I think, around all of this. There was talk yesterday of investment in net zero technologies, which makes sense with COP26 coming up. There was talk also of significant investment in nuclear technologies. This, of course, is continuing a theme that was talked about earlier in the year. There's also, and again, this reaffirms a general theme, I think, that was coming through within the budget yesterday about, now that we've done Brexit, we can now do different things with overseas partners. And so a global investment fund was talked about to bring in funding from overseas for technology endeavour. And, if we look back, UK technology businesses have been very successful. I know a number of our clients, for example, have been in attracting money from right the way across the globe, because of the value that's placed on UK innovation to date. So, hopefully that will also assist. Also talked about an increase of funds to universities and other research institutions through these funds. Significant increases in Innovate core funding to help, I quote here, companies connect capital, skills and connectivity. Now, it's not clear from this whether this is actually going to enhance the SMART award type of grants that go directly to companies to enable them to prosecute their innovation and R&D, or whether this is something to do with grants to enable them to buy in support from consultants, if you like, to assist them to access skills and capital. So I think that, again, it's one of these areas that we're going to be looking in a little bit more detail at later. There was also the announcement of a new advanced research and invention agency to carry out high risk, high reward research to support groundbreaking discoveries across the UK. Again, we're looking for more information on that. So I think there's a number of things signposted, continued commitment to the theme that's been in a series of budget announcements over the last 5 to 10 years about the importance of innovation and R&D to the UK economy. So, I think it's been, I'm not saying it's necessarily totally good news for the sector, but it's good news in that, not more has been taken away. But I mean, if we turn to sort of thinking about sectors, another sector which has suffered massively over the last 18 months or so is clearly that of hospitality and leisure. There were lots of mentions of opportunities for this sector in the budget yesterday. But Mira, how do the announced measures really impact on the businesses?
I think there will be some relief that there's no immediate increase for alcohol duties, which had been previously earmarked for this autumn. So that is some good news for the hospitality industry. When other there's going to be other increases in wages and other stuff, and this is some will be relief. And also, as Alex mentioned previously, the duty change in alcohol will lead to a higher strength drinks going up in price and lower duty on drinks ranging from sparkling wine to draft beer. The draft relief will also help the industry a bit, cutting the tax on drinks served from pubs such as beer and cider by 5%. So that should, that'll be a bit of a relief when you look in on the whole, where there's going to be some highs of other supplies, where this is, the duty change will be welcomed by the hospitality industry. But on the other hand, that you also need to be, hospitality will need to bear in mind that the current VAT rate is 12.5%. And this is scheduled to increase to 20% on the 1st of April 2022. And so there were no mention in this budget that they were going to extend the 12.5% for a bit longer, or are they going to reduce the VAT rate on that to another rate? There was a high expectation there would have been some announcement around it, but there was nothing mentioned about it. So I would really say watch the space on that. I don't know whether there's going to be anything changing during the March budget, because that is something, even though the duty prices are going down, the VAT rate is going to go up from 1st of April 2022. So on the whole, the hospitality industry, yes, it's a bit of a relief. Would I say it's a total good news? Probably not. But it is definitely will be welcomed by some of the pub chains and other hospitality industry. But on the whole, I think is what to look out for is the VAT rate going to change or not come 1st of April 2022.
Thank you, Mira. And Darren, what do you think, sort of for a wider business context for the hospitality and leisure industry?
Yeah, I think Mira summed it up well there, that it's not a clear-cut win, that's for sure. There's also the 50% discount in business rates for the hospitality sector, which clearly is welcome news, albeit it's capped at 110k, so it's going to be for the smaller end of the hospitality industry, I suggest. But even taking that into account, it's definitely not clear-cut, and that is only half of the story. There's, as we've already mentioned, the inflationary pressures across the economy is going to be acutely played out in the hospitality world. You know, just to name a few, national living wage going up to £9.50, it's, you know, almost a 7% increase, which I don't think there'll be any other sector that's more affected than hospitality, in my view. National insurance contributions, as we've already said, clearly hospitality is quite a labour-intensive industry. Again, will be impacted by that. We've heard in the news food shortages and so on, and transportation issues, which can only lead to increasing prices. And also, as I speak to my clients in the hospitality sector, there is a labour supply. Yeah, I have heard on numerous occasions of not being able to recruit chefs and housekeepers and bar staff. All of this is undoubtedly going to lead to increase in prices, perhaps above the 4% that has been mentioned. So that all in all, I would say that, okay, the duty and VAT and business rate positive, let's say, may well be outweighed or at least offset by the factors I've just mentioned. So I think if people are expecting to pay less at the bar, unfortunately that may not be the case. And I suppose one other thing to factor in is the hospitality industry does typically carry quite a lot of debt. If we do have a persistent period of high inflation, there's a chance interest rates would increase and borrowing costs will go up. So I think it's too simplistic to say that this budget was a good budget for the hospitality sector. There's clearly lots of factors all at play here.
Thank you, Darren, for that. Picking up on your point about staff shortages, the poll that we ran just a few minutes ago was asking about, what was the biggest threat short term to people's business, and overwhelmingly the majority of people have come back at 47%.
Wow.
And said that they identify staff shortages as being the biggest issue for them. The next biggest issue at 26%, so it's quite a difference, is supply issues. And I think we're all talking to clients who are struggling with this, whether it's builders getting timber in from the Far East, or just getting retail products in from where they're being manufactured. And then behind that, at 23%, people are concerned about inflation being a threat to their business, and that again feeds back into what you and Mira have been saying about what's happening in the hospitality and leisure industry. So potentially, from what we're sensing, more may need to be done in the short to medium term to support that sector particularly. Talking of polls, I'd just like to ask people to vote on our next poll, which is, the government's levelling up agenda is intended to benefit the wider UK. Do you think this is at the disadvantage of the Thames Valley and the southern England, with a concentration on the north of England? So very grateful if you could post your votes now on that. But we've just been posed a question actually from the audience, which asks, whilst it might be a bit early to calculate, Ian, do we think that the tax changes in the budget are actually redistributive? So are we getting the levelling up, not necessarily just between regions, but actually the levelling up in terms of economics for the individual? Do we think that the budget has actually done the trick in terms of starting to be redistributive? I'm
not sure that is true. If I look at the capital, no change. My view is there's no redistribution there. Do the NIC changes make any difference to where people are? I don't think so, other than if you've got, let's say, more wealthy pensioners in the south of England and more wealthy self-employed people in the south of England, they're going to pay higher amounts of tax, that might contribute to a levelling up.
Okay, thank you, Ian. But I think, as our question said, it might be a little bit early to actually predict that. There's an interesting point that some people may not have picked up on actually in the Chancellor's statement yesterday, but he mentioned that the freedom to change tax rules more freely was an opportunity following Brexit. Sharon, do you think this means that there are more changes to taxes in the pipelines? Because the budget itself was quite thin on actual tax measures, wasn't it? It talked a lot about expenditure. And thank you.
Yeah, so I do actually. I think it'll be watch this space for a number of years. I mean, clearly, the changes to the alcohol duties yesterday, the freedom to do that was very much given to the government now, because they don't have to follow EU rules on alcohol duties, and the Chancellor did actually state that almost as a, yeah, this is great, I can now do this. The R&D tax credits that I mentioned just a few moments ago, the fact that that might be focused more on British businesses, I don't think those changes could potentially be so wide-ranging if we were still in the EU. There are also a few sort of slightly more unusual changes on some of the group relief international stuff that which shows that they're beginning to tweak our policy no longer, because they're no longer constrained by EU rules. What do I think might be up for change? Potentially EMI option schemes. Those are very much constrained, or have been constrained in the past, with what Europe has rubber stamped and allowed us to do. EIS schemes, which are a really good way for young businesses to get investment, again very much constrained by EU rules, and I'm expecting, once probably we're slightly over the pandemic period and people have time to concentrate on it, that might change. VAT is probably the other big example. As people know, we have a lot of things that are zero rated supplied or full rated supplies. We will have a lot more freedom to determine what we do and don't charge VAT on in the future. And again, I think it's only going to be a matter of time until we start deviating away from the constraints that we have been under in the past few years. Thank you.
And another question we've just been posed by a member of the audience is, has there been any good news for charities in the budget yesterday? Was there any good news? I'm not sure who'd like to take that, Ian or Darren, probably. Ian.
Well, I'm very happy to go first and Darren come on second. Yeah. I didn't see or hear charities mentioned once in the budget yesterday. So as far as I'm concerned, there's no change to the basis of taxation of charities. All the reliefs and exemptions that were there before still are. In terms of charitable giving, gift aid still works, gift of land and listed shares still works. I didn't pick up on anything, Darren, did you?
No, it might be one for me. Was there some changes around grants mentioned?
No, there's no changes, but the government is offering a lot of grant now for the local authorities, and that might get passed down to charities. But like Ian mentioned, there was nothing specific for charities on the whole. But then maybe some charities can dip into this grant funding, which is going to be available for them. Other than that, there was no major announcement as to charities.
Yeah. So sorry, there's nothing direct, I'm afraid. And a final question from the audience was, what do we think is going to be the impact of tax changes on dividends for the pensions market? I don't know who would like to take that first. Any volunteers? I haven't got a volunteer at the moment. I'm going to have to pick somebody then. Darren, what do you think in terms of the impact on the pensions market?
I suppose it's too early to tell, is the answer. If we're talking about financial institutions and where they're investing, I suppose a lot of that will be driven by market forces and not necessarily by dividend rates. I think overall it's probably not the best, but I wouldn't necessarily say it's going to change too much. 1%, albeit is significant, I don't think we'll have a wholesale change.
Yeah. Okay. Well, fine. Just coming to our final poll and the results of that. Actually, pretty evenly split. People aren't sure about the levelling up agenda from a regional point of view, whether it does put Thames Valley and Southern England at disadvantage. I think there's going to be a question of watch this space and see where we get to. That brings us to the end of our Q&A and panel session, for which many thanks to our panel. And in summary, I think from our discussions, as with all budgets, there have been clear winners and losers, and some where we're not quite sure whether they're going to be winners or losers, and we'll just have to wait till the legislation or further information comes out. Key loser in the budget yesterday, of course, was Keir Starmer, suffering from COVID and therefore deprived of the traditional key opportunity for the leader of the opposition to point out flaws in the Chancellor's strategy. Amongst the winners might seem to be the lower paid workers and benefit claimants, but there's been quite a lot of debate in the press earlier this morning and ongoing about whether they really are winners or not. Public sector workers haven't been much mentioned in the press, but the freeze on public sector spending, salaries has been lifted. So I think there may well be some winners there. Businesses in leisure and hospitality and entertainment, as we've been hearing, may benefit, the former perhaps in the short term, not necessarily the medium term. And of course, some drinkers, providing you're drinking champagne, as the Shadow Chancellor pointed out. There are also the winners who won because measures weren't announced that might have been and had been widely expected. So there were no changes to CGT, as Ian was saying, and no changes to inheritance tax either. And clearly amongst the losers were the smokers and the ultra long haul flyers. The smoking one is an interesting one because I think, there are a couple of points in the budget yesterday where Rishi was talking about it being a budget to improve the health of the nation as well. And they're trying to, that therefore is behind the increased duty on the higher percentage alcohol drinks as well. Be interesting to see if we will become a very healthy nation following on from this budget. So finally, thank you all very much for joining us this morning. Thank you to the team, particularly those that you don't see on the panel. So Lizzie Uzzell, Georgia Burrell and Andy Cowie. If you, the audience, have any questions about how the budget might affect you or any of the questions about tax, then please do contact us to discuss them. We're more than happy to have a chat. Thank you all very much and have a good rest of the day.
Thank you.
Thank you.